Have you ever wondered why sometimes you make the right investment decisions, but end up selling in a panic during a market downturn? Have you ever wondered why sometimes you buy overvalued stocks, getting caught up in the hype of a new era? Meet Seth Klarman, an American billionaire investor, a hedge fund manager, and the president of the Baupost Group.
In our previous video, we reviewed some highlights of Seth Klarman's book, Margin of Safety. Today, we will further study and examine some of the viewpoints from the book. In an interview with Charlie Rose in 2011, Klarman said that investing is an intersection of economics and psychology, and while the economics part, the valuation of business, is not that hard, the psychology part is harder. Taking advantage of Mr. Market does belong to the part of psychology. So, let us get to know Mr. Market. The concept of Mr. Market was introduced by the father of value investing, Benjamin Graham, in his book, The Intelligent Investor, in the year 1949. He used Mr. Market as a metaphor to describe the behavior of the stock market. Graham envisioned Mr. Market as a person who would come to investors every day and offer to buy or sell their shares at a certain price. Mr. Market's mood would fluctuate between euphoria and depression, and the prices he offered would often be irrational and unrelated to the underlying value of the company. Seth Klarman explains that the daily fluctuations of Mr. Market can impact investors' decision-making. If a stock rises in price after an investor's purchase, they may become influenced by the positive feedback provided by Mr. Market and believe the security is worth more than their initial assessment. Conversely, if a stock declines in price, investors may panic and sell at the wrong time, worrying that Mr. Market may know more than they do. However, if the stock was originally purchased at a bargain price, the rational course of action would be to take advantage of the lower price and buy more. Klarman writes,
The reality is that Mr. Market knows nothing, being the product of the collective action of thousands of buyers and sellers who themselves are not always motivated by investment fundamentals. Emotional investors and speculators inevitably lose money. Investors who take advantage of Mr. Market's periodic irrationality, by contrast, have a good chance of enjoying long-term success.
In 2020, the COVID-19 pandemic shook the world and the financial markets, causing unprecedented volatility and uncertainty. In March 2020, the U.S. stock market experienced a series of circuit breakers, triggered by sharp drops in prices. 4 times in less than 2 weeks, trading was halted for 15 minutes to allow investors to assess the situation and avoid panic selling. Many investors saw their portfolio value drop as stock prices plummeted. However, some investors saw this as an opportunity to buy stocks of undervalued companies. These investors were able to make considerable profits as the market eventually recovered. According to Klarman, security prices can fluctuate for 2 main reasons: changes in business reality or changes in short-term supply and demand. Business reality can change due to a variety of factors, including company-specific or macroeconomic events. In some cases, security prices may fluctuate due to changes in investor perception rather than changes in business reality. For instance, biotechnology companies' shares may experience a sudden surge in price, despite no change in company or industry fundamentals, simply because investors are willing to pay much more to buy the same thing. In the short run, supply and demand alone determine market prices, which can be influenced by factors such as year-end tax selling, institutional stampedes out of a stock, or rumors. Investor perception may be just as important as business reality in determining security prices in the short term. However, investors must always look beyond security prices to underlying business value and compare the two as part of the investment process. According to Klarman, many unsuccessful investors view the stock market as an opportunity to make money without working, rather than as a means of investing capital to earn a decent return. The prospect of quick and easy profits incites greed in investors, as anyone would enjoy an effortless gain. Klarman writes,
Greed leads many investors to seek shortcuts to investment success. Greed also manifests itself as undue optimism, or more subtly, as complacency in the face of bad news. Finally, Greed can cause investors to shift their focus away from the achievement of long-term investment goals in favor of short-term speculation. In the short run, resisting the mania is not only psychologically but also financially difficult, as the participants make a lot of money, at least on paper. Then, predictably, the mania reaches a peak, is recognized for what it is, reverses course, and turns into a selling panic. Greed gives way to fear, and investor losses can be enormous.
Let's use a quote from Klarman's book to sum up. You cannot ignore the market. Ignoring a source of investment opportunities would obviously be a mistake, but you must think for yourself and not allow the market to direct you. Due to the length of this video, we will conclude our discussion of the margin of safety here. Please subscribe to our channel to stay updated on our future discussions of value investing.